Welcome. Introducing myself, my name is Van Ritchie, Sales Consultant at Your Land Developments. In partnership with Mortgage Domain, we have a very special guest to continue our mini-series on finance around buying property. This is the second episode of our three-part mini-series, and this session is going to dive into more technical details. Let's begin. Our special guest is Mark, Director and Senior Mortgage Broker. Welcome back, Mark. Can you tell us a little bit about yourselves if our customers haven't watched our first episode?
Yeah, absolutely. Thank you, Van, again for having me in for today's session. As Van mentioned, my name is Mark Polatkesan. I'm the Director and Senior Mortgage Broker of Mortgage Domain. Mortgage Domain are a construction-focused mortgage brokerage, and we service all areas of Victoria. The business has been around for the last 6 years. I myself have been in finance for the last 18 years, and we service, as I mentioned, all parts of Victoria.
Thank you. Let's get into it. So today's presentation, we're going to cover a number of things. Our topics are going to cover loan structures and interest rates, lenders' mortgage insurance, and finance pre-approvals. So Mark, what are the different types of loan structures that are available? Which is the best for land off the plan? Can you take us through that?
Absolutely. There are a whole range of different products available out there in the market, and every bank's got their own way of doing it. So the same type of product may differ from bank to bank, but we've just got some of the, I suppose, the fundamentals when it comes to sort of looking at a type of product. The first product that I'll start with is a fixed rate loan. Fixed rate loans do have some pros and cons. So fixed is exactly what it means. It means that the rate is fixed and it's locked in and it's not subject to change for a period of time. Usually you can lock in your rates from anywhere from 1 to 5 years. Some lenders can actually allow a greater period of time. Typically, the longer you fix in for, the rate can be a little bit more expensive. What we're seeing at the moment is the best value for fixed rates could be anywhere from 2 to 3 years. We're seeing fixed rates at an all-time low as well. So some lenders are out there in the market at about 1.79 to about 1.89, which, in my 18 years of finance, I haven't really seen before. So going back to, I suppose, the pros and cons, fixed, obviously, you've got some certainty in your repayment, so you know that repayment's not going to change for that period of time. Some of the cons could be the banks will only allow you to make a limited amount of extra payments. So if you're paying $1,000 a month as a standard repayment and you wanted to maybe pay $2,000 a month, you can pay that amount, but sometimes that amount of extra payments can't exceed $10,000, $15,000 or $25,000, depending on the bank that you're working with over that fixed rate period. Most banks also won't allow you to have an offset account linked to your fixed rate loan, which I'll go into detail a little bit later. And also things such as redraw. So redraw is basically when you're making extra payments on your home loan. Let's say you're ahead on your repayments by $10,000, that redraw may not be available on a fixed rate loan. So something to consider. Variable rates, as the name suggests, they are variable. They're always subject to change. Usually the variable rates are sort of driven, or they're priced with the cash rate as well. So the Reserve Bank currently is at 0.1%. Obviously, if the rates, the cash rate fluctuates, obviously then your variable rate is subject to change as well. They are a lot more flexible, so you can usually make unlimited extra payments on these loans. You also have redraw available as well. So if you are making extra payments and you needed that money come rainy day, you can take that money out whenever you like. You've also got the ability to change lenders without any potential penalty. So things such as break costs usually will only apply for a fixed rate loan. Variable rates, usually the cost to get out is a lot cheaper. Basic home loan is basically, I suppose, what we call like a no frills type home loan. So it will still maybe come with a redraw facility, but it won't have things like an offset account that you can link to that loan. Usually these products can have cheaper maintenance costs or very low cost associated. Usually these type of products won't have any sort of ongoing fees or annual fees. Okay, but as I mentioned, they don't usually come with an offset account. So just to explain what an offset account is, it's a savings account which is linked to your home loan. So let's say, for instance, your pay will go into this offset account ordinarily, and let's say you've accumulated $10,000 in savings in your offset account. Because this offset account is linked to your home loan, the bank usually checks this balance every single day. And when they go to charge your interest on your mortgage, so interest on your mortgage is actually calculated every single day, but charged monthly, right? Usually in arrears. Let's say for that month, you've got a $200,000 mortgage balance, you've got $10,000 in your offset, the bank would charge you interest on $190,000. So it's basically getting your money towards to work for you and reduce the amount of interest you're paying in your home loan. A line of credit, which is one of the last ones that we've got sort of listed here, it's something that's sort of falling out of favor with a lot of banks and purchasers as well, or borrowers, sorry. They are typically very expensive. Yeah, I suppose that the easiest way to explain what they are is like an oversized credit card. They've got an approved limit of, let's say, $500,000. Usually you're not really paying that loan over a period of time. There's no principal requirement for that loan. So, even 5 or 10 years after you've had this mortgage in place, you can still owe the same amount of money because the bank's not forcing you to pay it down. They only require interest repayment on that balance. And that's basically what a line of credit is. The best loan for you can obviously depend on what your sort of long-term goals are and how risk adverse you are as a borrower.
Definitely listening to you, Mark. I think that customers can benefit from connecting with someone like yourself to actually go through and decide which loan will actually suit them, and you can take them through this a little bit more. So thank you so much for that.
Thank you.
What is the difference, Mark, between fixed and variable interest rate loans? Which one would you consider is more suited to land?
Yeah, look, some lenders don't actually allow a fixed rate on a construction loan. The reason for that is construction loans have what we call progress payments. So whilst the bank has approved a limit of, let's say it's $500,000 towards your home and land, they don't actually give you all that money from the land settlement. What they do is they typically just lend the land component because that's what they're having to provide to the land developer. And then they retain the construction money. And what happens with the builder is they'll actually claim progress payments during the course of construction. So usually with a HIA contract, there are 5 fixed stages, and I'll just go through them individually. You've got your base stage, your frame, your lockup, your fixing, and then completion. So upon completion of each one of these stages, the builder will actually send you an invoice, which will send to the bank. Then your bank will incrementally increase your loan. Month by month, your interest repayment will also increase because there is more money owed to the bank. Because of these multiple payments that are being released, most banks won't allow you to fix that loan, right? If you are wanting a fixed rate from the very beginning, usually what we can look to do is actually split your loan. So what I mean by that is we can maybe look at a land loan to be a fixed component and the construction can be variable. That way, once again, you're sort of getting the best of both worlds as well. Sorry. So obviously your fixed components obviously aren't going to change in terms of repayments. Your variable component, obviously, you can make extra payments to that. You can link an offset account to that as well. So that way you're sort of protected from both ends. There are a handful of lenders, if you did want a fully fixed component or fully fixed loan, there are some banks that allow you to fix from the very beginning for land and construction. It's something that's quite unique to them. So if that's something you want to do, definitely engage with a broker because they'll be able to point you in the right direction as to which banks can offer that.
Great, thank you. What sort of repayment structures are available? Yep. And what is an average monthly repayment amount that I'd be looking at if I was a purchaser?
Yeah, look, it's a very hard question to answer. It's really dependent, obviously, on the type of rate and obviously, what the rates are doing at that point in time as well. I'll just give you a very, very rough guide, and obviously everyone's circumstance can be very different to the next person as well. Once again, go with what you're comfortable with in terms of borrowing. But yeah, if I assume a 3% interest rate on a 30-year loan term, you'd be looking at repayments of $2,740 if you were to borrow $650,000 from the bank. If you're looking to borrow $750,000 from the bank, then your repayments will be $3,162 per month. These are minimum repayments, bear in mind. $850,000 would equate to $3,583 per month as a repayment. So, obviously you can pay over and above these repayments if you wanted to, but these are the minimum amounts based on a 30-year loan term.
Wonderful. Thank you. What is pre-approval? Is it the same as formal approval? When do you do it, Mark? Like, when do you go and do your pre-approval, and what is the difference?
Yeah, look, pre-approvals are normally what the banks will issue when there isn't a property involved. So let's say you just wanted to make sure that you're in a position to borrow money from the bank. You haven't really entered into any land or building contracts as yet. You just want to have certainty to know that the banks will actually issue that approval. So basically, the banks will assess your application, assess your documentation and your information, and they'll issue an approval subject to certain conditions being met. So usually with those, that approval, it'll be subject to finding a suitable security, because at that point they don't know like where the land is, where the bills are, what the price of the bill is going to be. It usually will be subject to evaluation as well, and potentially further checks from lenders' mortgage insurance. The validity for pre-approvals, this does differ from bank to bank, but I suppose a hard and fast rule would be anywhere from 3 to 6 months. The more common time frame would be 3 months, which can impact land purchases as well, particularly if you're looking at title dates anywhere from 6 to 12 months away or even further. It's always good to speak to a broker that's actively working in the home or land space, because they will monitor your application a lot closer. So if there are any sort of change in circumstances to you or the bank's lending policies, they can obviously pinpoint that up front and make sure that they've got a plan prior to your land settlement taking place. So that way you're not delayed on your settlement in any which way. Formal approvals, basically, their issue with the bank is completely satisfied with your loan application. They've vetted your land contract, they've vetted your building contract, they've conducted a valuation as well, and the valuation is satisfactory. They're happy with the type of property that you're looking to purchase. And usually what then happens is once they've issued a formal approval, they'll then issue to you as a borrower a letter of offer. So it's basically saying that we're happy to lend you the money. It's now up to you to accept our terms. You'll obviously read through the letter of offer and the loan contract and make sure that you're happy with everything and actually fits or matches what you've actually submitted to the bank. Once you're happy to accept that, then the bank will then be in a position to settle your loan.
Thank you. This is a tricky one, and I'm sure some people are going to, and I'm sure a lot of you get asked this a lot, Mark. What is LMI?
Yes.
Does everyone have to pay it?
Look, not all the time. So lender's mortgage insurance, just to explain what that is, it's an insurance policy against the bank's money that they're lending to you whenever you usually borrow over 80% of the purchase price. There are some lenders that might have promotions where they'll lend you 85% with no mortgage insurance or 90%, but usually it's 80% or less. Mortgage insurance will not apply. You can avoid mortgage insurance by obviously contributing 20% deposit, as I mentioned. If you have a guarantor, so let's say mum and dad have got a property and there's a sufficient equity in that property that they're happy to put up as security, then obviously you can avoid mortgage insurance costs against your own purchase. There are some government schemes that are actually on offer at the moment, such as the First Home Owner Low Deposit Scheme or the New Home Guarantee, which will allow you to borrow up to 95% of the property's value if you are an Australian citizen and the income requirements are being met. So that's $125,000 for a single applicant, $200,000 for a couple. Income can't exceed these two values. You would then be eligible to borrow 95% with no mortgage insurance. You need to ensure that obviously you're submitting your application to one of the participating lenders, because not every lender is actually on this scheme. It's always good to speak to a bank or broker just to ensure that you meet the requirements for that scheme as well. There are some banks that will actually borrow up to 95% of the property's value. Let's say you've got a 10% deposit if you are of a certain profession. So that could be doctors, lawyers, accountants, certain professional industries. They can waive the mortgage insurance associated with that purchase.
Thank you. I think this was one thing that we really wanted covered for our customers, because often when you are embarking on buying, you hear these acronyms that just don't make sense whatsoever. And LMI is one of those acronyms that you're going to be hearing, and it is Lender's Mortgage Insurance. And as we always say, go and speak to a professional like yourself to actually delve more into this. So
if I can add that as well, Van. So mortgage insurance, there's no fixed amount as to what it's going to cost. And so the more deposit you do have, the cheaper the mortgage insurance is going to be. So that's something to keep in mind. So if you have a 5% deposit versus a 10% deposit, chances are your mortgage insurance is going to be a lot more expensive. If you can continue to save and get close to that 20% requirement, you will be saving yourself money with mortgage insurance.
Yes. And I think this is where buying off the plan actually allows you the time, to increase some savings. Yeah.
Absolutely.
So this is a bit, before you know it, here we are. We're at the end of our session. So thank you so much. Next time, if you love this particular session and this episode, you can join us again. And we will be covering in our next session valuations, stamp duty, and land tax. Some of these topics we did cover in our first session and this session, but we're going to go into more in our final mini series. So if you would like to join us, please do in our next session. So we will get onto that in the next one. But if you, in the meantime, want to reach out to us at Your Land Developments, you can at melbourne@yourland.com. If you want to reach out directly to Mark and his team, you can do that also. Highly recommended. Mortgage Domain, hello@mortgagedomain.com.au. Thank you, and we'll see you next time.